Good morning. Thank you for joining us for today's edition of Coffee Talk. My name is Sean O'Brien, president of Quick Rate. And as always, I'm pleased to be joined by Steve Huntington. Steve, you want to go ahead and introduce yourself?
Yeah, thanks, John. Good morning, everyone. Thanks for coming and spending an hour with us on a Friday morning again for our August Coffee Talk. My name is Steve Huntington. I'm the director of analytics here, and I've spent my entire career working with community financial institutions, and about more than half of that career now, I believe, is here with you, Sean.
All right. We're glad to have you. Today, we also have joining us David Ruffin. David heads up our telecredit division. So we thought this month we would share some of the credit insights and emerging trends that David continues to monitor that they work through and see in the IntelliCredit division. So David, you want to go ahead and introduce yourself?
Thank you, Sean. As always, enjoy the invite to join you periodically on Coffee Talks, but also, we routinely do quarterly updates. And I won't even get into the how many years I've been in the industry, so you can probably surmise that by looking at me. But I'm delighted to be with you today to talk about some credit trends.
Thank you. Glad to have you. All right. So as always, we will send out a email next week with a link to today's discussion, along with a copy of the slides. Throughout the presentation, you can chat with us either using the chat feature or the Q&A box. We'll monitor those and take those questions as they come. Just a couple of polling questions, as always, to kind of get us started. And let's just launch in here. There's a couple of them. It's kind of a double-barreled question. Have you undergone an audit of your reserves for CECL? And secondly, if so, have your auditors responded? How have they responded to your implementation? So we'll just give this a few seconds or 30 seconds or so to go ahead and answer. Appreciate any responses that you're willing to make. All right. Go ahead and share these. So quite a few of, 78% between yes and in progress. So that's interesting. And then, 73% positive, 27% mixed. So certainly appreciate those responses. For any of those having any issues with auditors, certainly don't hesitate to reach out if we can be of some assistance. All right, let me go back to the next question. Again, another little double-barreled question. This one's really focused more on exam, the regulatory exam. Have you undergone an exam for CECL? And then secondly, if so, how has your examiner responded to your implementation? So again, we'll give this 30 seconds or so. Okay, thank you again. We'll just go ahead and share these results. 59% or 2/3 of you between in progress or have, 83% positive, 17% mixed. So again, thank you for sharing that. And again, if we can be of any assistance, please let us know. And then the final question is just really around CRE. Many of this may not apply to, but which of the CRE subsets concern you the most, if any? We'll go ahead and just leave this up here. All right, we'll go ahead and end this one and share, kind of evenly split 1 to 4 family, kind of leading the way, and then office, industrial, and multifamily. So again, thank you all for participating in our polling questions. Again, we'll share those results with you as part of the email that goes out next week. Again, just a slide just to kind of remind you of some of the continual updates we tend to make. They're always optional in nature, but designed to try to hopefully make the administration of the CECLSolver more informative and hopefully more streamlined wherever we can do that. So we've talked in the past couple of months about the warm values for those of you who have us calculate your warms, having those uploaded for you. Steve, anything you want to add there?
No, it's the same same information that we've shared for the last couple coffee talks. That's our some newer functionality there that for all of our users who we are calculating the warms for, as part of that process now, instead of just ending the process at sending you that Excel file that you would go and use to plug in the warms into the tool, we now finish that out by going ahead and actually populating the warms with those values so that you can click on that pre-populate button and choose a methodology and a date that we've calculated the warms and have them pre-populate right there for you. And for our users that are not calculating their warms with us or doing it independently, if you wanted to see some of the peer-based data that we have, right? The NCUA gives some decent guidance on warm calculations for the industry, and we now have a very large proprietary database of our hundreds and hundreds of CECLSolver users, and we take that data as well to share with you a couple different ways of getting at how your peers are calculating warms and what they look like. So you can now pull that data directly into the warm column on the tool, as opposed to just looking at it elsewhere and having to manually type them in. Which leads me
Yes.
to our next. So this is something we've shared with you guys the last few months here is our, if you go to the next slide, Sean, our database. I had started pulling these numbers for last month, but I don't know if I got them into a slide, and I wanted everybody to have a firm understanding of where that data is coming from and how much of it we have now, because that's extremely important to put any weight behind some of these trends, because this data is not publicly available data, right? Nowhere in your call report are you getting reserve, warms and Q factors and reserve levels at the segment level for the other institutions in the industry. And so now that we have over 450 different credit unions actively using the CECLSolver tool, most of you quarterly, some of you more frequently than monthly. We have users from 45 different states, everywhere from $9 or $10 million credit unions up to $7 billion credit unions, and averaging around 250 million. And they've run, you have run over 5,300 scenarios and over 110,000 segment level scenarios, including warms and Q factors and reserve levels. So when we share these trends of what our users' warms are looking like and how they've been directionally headed in the recent past and where they're headed right now, you can know that there is a lot of really good widespread geographically and financially data behind those trends. In the past, we've shared that data as one big, did I not put? Oh yeah. We've shared it as one big gigantic table that we've jammed here into the presentation, but we wanted to make sure that it was available. Yeah, you can go to the next slide, sorry. In the tool as well interactively. So if you go to the knowledge base page on our CECLSolver and you click on the CECL peer data, you will get something, and we've just updated this again to make it even more helpful. So the current page looks as follows. If you go to the next slide, we reorganized it around. So when you look at the data, you can see by segment either warms, Q factors, or collectively evaluated reserve levels for each segment of the loan portfolio. You can click on a segment and then the chart up there will update on the right. You can look at median trends, or you can look at 25th and 75th percentile, which I think honestly that kind of range between the 25th and the 75th is more helpful. If you're trying to just kind of walk through your portfolio and make sure that your warm calculations are within tolerances, so to speak, or kind of not outside the peer norms, that looking at that 25th to 75th percentile range, except for some aberrations or specific circumstances where it may be different for your institution, is a great place to start. So now we chart all that data, and you can see where those what those ranges look like at the segment level not only for maturity calculations, but also for Q factor ranges and reserve collectively assessed reserve levels. And so we hope that'll be helpful. We're going to continue to update this part of the platform to really utilize and mine that really good internal non-public data that we have now. So you'll be able to slice and dice it by geography or by size and lots of other ways in the future, with the purpose of just giving you more accurate, more defensible ways of looking at relevant local peer data, which is critical to get a feel for where you sit within your peers for reserve calculations and everything related, honestly, generally to asset quality. Sean or David, should I say?
All right. Yes. So at this point, we'll turn it over to David. He'll just kind of talk about just what they're seeing in terms of credit performance and any some emerging concerns. So David, I'll move the slides for you, but I'll let you take it from here.
Yes, thank you very much, Sean. Yeah, I'd like to just kind of maybe focus on what might actually be more of a Q&E aspect of what you're doing with your CECL. We have the honor of actually now doing loan review engaged with one of the top 5 largest credit unions in the country within the last year. But what I'd like to share with you is kind of our whole focus at IntelliCredit is, as so much of quick rate and quick analytics is the community financial institutions, whether they be credit unions or banks, but they fall in that category. But there has been a trend that is, I think, I wouldn't say necessarily troubling, but certainly one that would lend itself to more regulatory scrutiny for the community financial institutions, including credit unions, and that is there's been some significant loan growth disproportionately to some of the more mega banks at the financial institutions. There's certainly been a trend of late that's showing a little bit of decline in reserves, and particularly for those credit unions that have robust commercial portfolios that are either growing. There seems to be a trend that the one segment of the U.S. Whole spectrum of credit providers, and that goes all the way from the CMBS, highly sophisticated financiers of credit, of real estate, REITs and things like that, all the way down to the community financial institutions, is that the one segment that seems to be growing in CRE, which is arguably the most of concern to all regulators, are the community financial institutions. And couple that with the fact that I indicated a moment ago that reserves tend to be declining at some of the smaller institutions, not significantly, but declining counter to what some of the larger financial institutions are doing in terms of reserves. It's really setting a table for, I think, even more scrutiny that I think all credit unions need to be aware of, particularly since there is, if you have some CRE. But let's talk a little bit more generally about what the trends are. Again, from a historic standpoint, credit metrics remain fairly acceptable. Certainly nothing like we saw in the great financial crisis. But there are some dark clouds emerging, and a lot of it is the roots, of course, in the heightened interest rate, the record acceleration of interest rates. I heard just this morning that Chairman Powell has virtually tipped his hand now and saying it's time for a rate cut. But the other thing is the inflation, of course, has taken its toll, understandably, with the key metrics of credit risk, which are things like LTVs and also debt service coverages. We're seeing, good underwriting across the industry. It's the servicing or post-booking assessment of credit that seems to still be spotty across our customer base, where we are observing, credit processes and also looking at loan review work. We particularly those, disproportionately to credit unions, perhaps because of the nature of your lending portfolio concentrations, there is something I'm sure most of you are quite aware of. There's kind of a bifurcated consumer borrowing base out there between what we call the paycheck to paycheck people that are more disproportionately negatively impacted by inflation and interest rates, and those with more well-heeled balance sheets with 401ks and so forth. We're certainly seeing some degradation in some of the consumer purpose lending, and that is unfortunately leading even some of the delinquencies and increased stress in some of the commercial portfolios. But we are certainly seeing some more regulatory activity, particularly as it focuses to credit processes, internal controls, assessments of the way you are looking at your credit and things of that nature, as well as, frankly, in the last quarter, we've seen even more and more focus on regulatory scrutiny about further downgrades, non-accruals, and things of that nature. One of the things that we all have to be aware of, that irrespective of a rate cut tomorrow or whenever that may come, credit is a much longer term process. Documented is explicitly in the fact that it's estimated that we've still got over $1.5 trillion CRE, commercial real estate loans in the financial industry, have to be repriced between now and the end of 2025. And as I said, we all know intuitively, of course, that means almost a direct degradation of things like debt service coverages. We're not even talking about rising cap rates, which places a damper on valuation. So they're getting squeezed to some degree. CRE in particular is getting squeezed from both ends of that spectrum. But again, as I alluded to, smaller banks and smaller financial institutions generally seem to be the growth center for a lot of CRE, while other providers are fleeing it. So next, the advice I have for particular credit unions that are involved in any degree of commercial real estate lending, and this comes from unfortunate discussions I've had with banks and credit unions that are having some regulatory scrutiny much tougher than they had a year ago, is this issue. And one is, accept the fact that commercial real estate lending is like two halves of the same walnut. And that is, one is most people, seasoned veterans in credit unions, understand we underwrite the borrower, the member of the credit union, and the project being financed. And we do that to the best of our ability. That's now being seen as only half the walnut. The other half of the walnut is, what is the supply and demand dynamic in the various footprints that your credit union is lending into. And either the dearth of information about that or inadequacy of that assessment of the supply and demand, and not just in a general sense, but also tied. That's why we asked the question specifically about the subsets of commercial real estate that may characterize your concentrations of lending. How much of those are being looked at very distinctly relative to, say, industrial or retail versus 1 to 4 or multifamily, any of that type of thing. So that's now coming as the added burden, if you will, of what your credit union needs to be focused on when you're trying to justify your credit processes and your credit quality around lending in these particular areas. Again, this is just appears to be ubiquitous around, the 4 federal regulators, including the NCUA, now are doing very much to try to sync themselves and speak with kind of one voice. I've certainly spoken at the Credit Union Business Lending Council roundtable each year. Last year it was in Coral Gables, and I certainly heard a regulator speak there, NCUA regulator, say that we really have to focus on credit process. We have to understand that the bank or the credit unions or banks are applying the standard risk management processes that they need, given the changing dynamic in the economic landscape. So next slide, I think, again, specifically, if you're focused on commercial real estate, these are some of the specifics that, frankly, we'd like to share with you, because these are some of the pain points that some of the smaller financial institutions are beginning to have to endure through regulatory criticism. And that's, again, assessing your subsets, using your own data, making sure that you accept the fact that your loan data is your DNA at your credit union. Do everything you can to find a way to understand that unique idiosyncratic data to identify emerging trends. Remember, we've said this for many years. There's a proven corollary between early detection of credit risk and lowered losses. It just has been proven many times over the years. And part of that is the ability to understand emerging issues. You don't want to wait until call report comes out with criticized classified information. You far before that, you're tasked with understanding what's percolating in your so-called past loan categories. Make sure your policies are current to the current environment. Many institutions we work with seem to be still dealing with credit policies that may be as much as a decade old. And things change, and I think that's a tedious exercise, we understand, but make sure your credit policies reflect the current sensitivities of regulators particularly, and your boards in terms of risk management. And I think that's the other common denominator we're seeing, is that in some of the regulatory criticisms, they even are giving credit to credit union credit management and management teams for understanding some of this risk, but somehow it's not getting transferred to board agendas, board minutes. And if there's not, and unfortunately in the world we live in now, if it's not in a board minute, it didn't exist. It's not, you're not going to be given a lot of credit for some verbal defense of what was discussed at this board meeting or the other. So I do think that's an important thing, is to just be ahead of what appears to be now almost a universal sense that particularly after last year's big 5 bank failures, that there's just growing concern that there doesn't need to be contagion. Nobody knows what the lay of the land is going to ultimately be in terms of our economy, but we all know that we're under greater scrutiny in terms of our credit risk protocols. So one thing that we are about, the next slide, Sean, that we've always been about at IntelliCredit is merging and making more synchronized, if you will, 3 very fundamental aspects of credit risk management, that being stress testing. We know we're big advocates of both loan level and portfolio level of that. You certainly can get the portfolio level of that with quick analytics, and we now can provide that at IntelliCredit at the loan level. Portfolio analytics, as I alluded to, is just the tapping of your unique DNA in your loan portfolio, the non-public information, to discern where the hotspots are, where the trends are emerging, and utilize the tools available for you to do that. And then lastly, in loan review, which we do a lot of work with in I think 34 states, we are just, I'll be agnostic to this. Obviously, we do a lot of work to that, but the one advice I have to you there, certainly don't cut back on loan review at this point in an efficiency play. They should be seen as your agent, part of your risk management team. You would want a loan review to detect a credit problem before a regulator does. That's not only a problem for a loan review credibility, but it's also part of your credit union's credibility if your engaged vendor has missed certain emerging credit. But the most concrete advice I could give you is, whenever you're having bids from third-party loan reviewers, make sure you ask for bios of who the reviewers are. Not to disparage the large accounting firms, but in some cases their business model is to send out young CPAs to do loan review. They certainly get the quantitative part of credit. They wouldn't be licensed CPAs with that. That it's the qualitative, or the more subjective part of credit, that frankly distinguishes that from accounting. And I do feel like having seasoned people that have kind of been there, done that, been in credit and lending positions at credit unions or other financial institutions would certainly give more credibility to understanding where credit risk may be emerging, and what does appear to be at least a year or two, perhaps, of more stress credit coming from these higher interest rates and the huge amount of inflation that we've just gotten through. So again, just wanted to reiterate, these are just basics to keep focus on, and we like to think in any way we could help you in that regard, please reach out to us. But again, Sean, Steve, thank you so much for having me join you today.
Thank you, David. Yeah, no, I think, again, I think is extremely insightful and helpful. Just to kind of give the backdrop of where we've been and where we seem to be potentially headed. Steve, if you want to just kind of talk a little bit about, what we're going to, ACL validation, some information, just a little bit of how the sausage is made.
Sure.
Share
And
your
you can switch to the next screen for just a second, but I'm going to go ahead and share my screen. A question that we get frequently is from our users that are just kind of trying to double check some of the math when they've run a scenario and maybe they're want to summarize it to the management team or to the board, and they go into the tool and they get the expected future loss rate, and then they multiply it by the balance, and it doesn't come out to exactly the same amount for the reserve amount in dollars as what the tool is suggesting. And that is typically due to a handful of different rounding errors. But we understand that people want to feel comfortable that they can get to that exact number to the digit whenever they need to, if ever asked to. So I kind of just wanted to do a quick walkthrough of the process of getting there and how we get there, and some of the misunderstandings that some users might have about that. So I'm going to go ahead and share my screen. I'll just paint a quick picture here. This is our guinea pig institution for today. Just pulled up a new scenario. Let's say we're looking at used vehicle loans, and we've calculated our WARM as 2.9 years. The tool goes back into history and it calculates a historical lifetime loss rate, which it has, which is 30 basis points, but not exactly 30 basis points, right? We round to 2 significant digits, as is the industry standard for things like net charge-off ratios and whatnot. Then we add a qualitative factor adjustment to it, and we get a lifetime expected loss rate of 70 basis points and change. But if you were to come to the summary page here and say, well, I need to validate that 1.408626 million, and I want to be able to get to that exact number. The first guess is what people tend to do is they take that, right, the expected loss rate, multiply it by the balance, and expect to get exactly this number. And what you'll inevitably get is something that is slightly off of that value, because this is a rounded value. So how do we get to this exact historical lifetime loss rate, especially with that multiplier and stuff in there as well? And how we do that, there's a template right here in the knowledge base, which we call our, where is it? Historical lifetime loss rate methodology and sample. And I've just so happened to have pulled that up here. So this is that example. It's a template with just dummy data in it, showing exactly how we would do that calculation. So here are the raw call report numbers, right? Charge-offs, recoveries, and ending loan balances. And what we do is we calculate a quarterly net charge-off ratio. And typically industry standard for those types of net charge-off ratios is they're always annualized. So these are annualized quarterly net charge-off ratios highlighted in that, I guess, slate blue kind of color. And how we would calculate, let's say in this example, you had a 3-year WARM, but you had a 2.5-year look back period. So we're going to gather those net charge-off ratios, those quarterly annualized net charge-off ratios over the look back period, right? The 2.5-year look back period. So that would be 10 quarters worth, right? And over that, you add them all up and then you divide it by 4. So because all these quarterly ones are already annualized, meaning they're already all multiplied by 4. So if you're calculating one aggregate loss rate over the look back period, you're going to add up all the quarterly ones and you're going to divide that result by 4. You'll get a a loss rate over the look back period of 0.24%. However, you have a 3-year WARM, right? So if you have 24 basis points in losses over 2.5 years, that your look back, but you're trying to calculate it for CECL over the WARM over 3 years, you have to take that result and multiply it by what we call the lifetime or the warm look back multiplier, which would just simply be the warm of 3.0 years divided by the look back of 2.5. So that's 1.2. So you take that 24 basis points and change, multiply it by 1.2 or whatever the exact ratio is, and you get to the lifetime loss rate. Keeping in mind that these values are all rounded here, but in the calculations, you can see here, there are infinite digits that go along. So if you were to just take that 0.29% and multiply it by the current balance, you're going to get something slightly off of what our tool shows. But if you wanted to validate the exact value, you could use this template, plug your data into it, and get to an exact calculation that can match for your management or your board or your auditors or examiners. If I head back here to the tool, it's going to show exactly another way to do a very quick validation of just to prove that, hey, I know this isn't exactly the same number, but it is obviously a rounding error, is kind of work backward with the math. If you take this implied CECL value and then divide it by the balance, you're working backwards to get to this lifetime loss rate, you will end up with something that rounds to 0.70%. So if you just kind of find the quickest way to prove that any discrepancy is really rounding, go backwards with the math and you'll end up with 0.698 something or other, which rounds to 0.70. So a bit of a technical point there, but we've been getting lots of calls about that from people trying to kind of back of the envelope prove all the calculations out. And we wanted to show you how, in what circumstances that might not work exactly as you would anticipate. Sean?
All right. Thank you, Steve. I'm gonna take
Oh,
back-
you know what? Hold on 1 second. While I'm here, since I've got a minute, if we head back to the knowledge base and we go to the CECL peer data, I know I showed you a screen show or a slideshow of this, but this is what it looks like in action. So if I click on, let's say, used vehicle loans, and I'm looking at warms here, I can see the trend of slightly declining warms for used vehicle loans for all of our 425 credit unions using the tool, average or median values over the last five or six quarters. If I want to see what that range looks like, I can click on the 25th percentile or the 75th percentile, and all this data updates. And then again, this chart here as well shows that. So I can not only see what the exact kind of or median is for all the other users, but even more helpful, I think, is showing that range of where the 25th and the 75th percentile are, to kind of just quickly, check to make sure your warm calculations or your reserve values at the segment level are somewhat within peer, I wouldn't say tolerances is probably the wrong word, but within peer norms. And when they're not, at least have a deeper understanding of why you might be an exception to the trends or to the typical range of values for that particular segment. Because that's a lot of times what we'll see in an exam is that, they're looking for something that doesn't fit the trends or what they're seeing from other credit unions. That's what's going to raise their flag. That's where they're going to dig in deeper and ask more questions. And if you've already sort of anticipated that and can easily have a written explanation that you've attached maybe even to your CECLSolver, where you have a paragraph description of why your warm or your reserve might differ from those norms, and you can build that directly into our tool. So if an examiner ever asks about it, you've already got the answer ready and waiting. That's going to make those exams go a little bit quicker and a little bit more pleasantly. And the same thing on the auditing side, right? Where they have expectations of where they expect these, what ranges they typically see them within. And obviously, if you're outside of one of those ranges, it's an immediate flag for them to dig deeper as well. So I hope that this can help out with that. Now
Great.
I'll stop sharing.
All right. Thanks, Steve. Grab back the
See
screen
where we're
here.
at here.
Yeah. Okay. So again, then just some further industry trends that Steve has been, sharing, and we're continuing to build out. Particularly insightful, as I think he'll start to talk to you about, is just some of the percentiles variances and what that means. Steve?
And this is something that is not, we're not seeing a whole lot of motion on, but I've shared it each quarter, and we had new data from the second quarter, so I wanted to go ahead and add it. we get a lot of credit unions who ask questions about the unfunded commitments, right? How material these reserve calculations are. Do we really need to establish a separate reserve on the liability side of the balance sheet for it, or can we just float a little extra into the contra asset account? And historically, that's not something that you've really been asked about. It wasn't even a line item on the call report, on your call reports, until the advent of CECL. And so it's brand new on the call report that they're asking you to separate out that potential reserve, and if it's necessary on the unfunded commitments, especially those that you anticipate having a high level of likely becoming funded in the near future. So we wanted to look at some stats on that. And since the advent of CECL, I guess at the beginning of last year of 2023, less than 10% of credit unions were calculating a reserve, or were establishing a reserve for the unfunded commitments on the liability side of the balance sheet. That has been very incrementally, slowly ticking downward. So now still 86% are reporting zero reserve for the unfunded commitments as a separate, at least explicitly, right, on the liability side of the call report. But for those that are, for that 15% of you, I expect for our users, since we have an unfunded commitment module that's part of our CECLSolver solution, my expectation is a much higher percentage of our users are doing that than the broader industry. But for those of you that are, we're not seeing much change in the level of reserves for unfunded commitments as a percentage of total unfunded commitments. It's been sitting at 5 or 6 basis points on the whole portfolio of unfunded commitments pretty consistently over the last year and a half. So just wanted to share those numbers and move ahead.
Yep.
This is something brand new. Wanted to kind of show some different ways where you can now, or in the future, you'll be able to even more so in our tool, slice and dice this data to get more helpful local, geographically, or like institution, focusing on institutions, in your asset band or in your size range, and look at those trends. And so I was curious. I did this more out of my own personal curiosity, when I was curious to see if I saw much regional difference in reserves to loans. And my first mistake was was using the NCUA's regions. Now, the NCUA has reorganized itself internally around 3 different regions, right? East, South, and West. My first inclination was, well, that's better than nothing. We probably need some more geographic diversity here to get a feel for how there might be differences in reserves in different parts of the country. But I figured I'd at least start with the NCUA's self-declared regions. And so as you can see, there's very minor, right? There's a 2 or 3 basis point at most difference in reserve levels between the 3 different NCUA regions. I get the distinct feeling, David, that if we were to add some more regions, if we were to be a little bit more granular about this, splitting out the Northeast from the Southeast, for example, that we might see some lower levels of reserves in the Northeast and maybe some higher levels of reserves in the West if we didn't include half the country in the West. Yeah. And so I'm going to try to build that out a little bit more for next month or next quarter, so we can share a little bit more granularity there. But we're not seeing it in the NCUA's region. As far as size is concerned, absolutely. If we look at the smallest credit unions and then we kind of work our way up the size ranges, we see the highest levels of reserves in larger credit unions, right? And these are using the NCUA's peer groups, right? Peer groups. This is 2 through 6. We did not add the reserve levels for peer group 1, which is credit unions under $2 million in assets. We didn't think it was really relevant to the trend of the majority of the country and the industry. But we looked at the other NCUA's peer groups, and we do definitely see a significant difference, right? Whereas the lowest level of reserves was in the $50 to $100 million credit unions, and then increasing somewhat to the 100 to 500, and then increasing significantly once you get over 500 million in assets. It would be, again, interesting if I think probably even more valuable if we change some of those bands or buckets to maybe look at by $100 million range, all the way from 0 to $1 billion, to see kind of where those not drop offs, but increases tend to be. As you increase in size, when do we really start seeing more increase in reserve levels? But we thought this would be a great starting point, so we wanted to share this data with you guys today, and just know that it's going to become a little bit more dynamic and insightful, I think, as we move ahead. Any thoughts on that, Sean or David? No?
Yeah,
No,
Said it all?
yeah, go ahead, David.
I just think keep an eye on what I alluded to earlier, to particularly to the degree that you've got exposure in commercial purpose CRE loans. That just generally seems to be a high sensitivity issue, and that does always beg the question: are you matching that kind of exposure growth to reserves, when at least appears to be universally a concern by the regulatory community?
Yeah,
And we thought,
and
what was?
yeah,
ahead,
I think
Sean.
I think, to the credit of all the credit unions, we've seen, if you look back a year ago, right, the reserves have gone up. Again, one of the, tenets of CECL was the idea that, as conditions started to potentially weaken, we would be out in front of that activity with our reserve levels. And so I think, we see that pretty much across the board. If we go back a year ago, every size of credit union has increased their reserve, and I think that's really what FASB was after, right? Was to in periods where we think we might entertain or experience some credit stress, we should be out in front of that activity, loading up the reserve, or at least substantiating a little bit further. And so I think message received and executed, that we do see that pretty much across the board.
And I would even argue that kudos to credit unions versus smaller community banks, because it's the community banks that don't seem to have gotten that memo.
Yeah, the gap between reserve levels for credit unions and community banks in your typical size institution is shrinking, because the commercial banks we're seeing kind of flatlining on their reserves, despite seeing similar chinks in the armor, right? Cracks in the armor for asset quality, whereas credit unions are seeing similar cracks in the armor, but they're obviously, at least at a statistical level, responding to that via incremental, right, increases in reserve levels. Another interesting fact here, just looking at this data, was we have the 12/31/22 column before the 3/31/23 column, so we see what the immediate impact of the implementation of CECL had on different size credit unions. And not surprising at all, the bigger the credit union, the larger the I think the directive was to increase reserves. So whereas smaller credit unions, the smallest, the under $10 million credit unions, or had very little increase in reserve immediately upon CECL being coming down the pike and being implemented, the largest credit unions had a very significant immediate increase in reserve from 58 basis points to 76 basis points in a 1 quarter period, where there really wasn't any change in asset quality. It was all driven by the change in the accounting policies.
Yep. Okay. So certainly if you have any questions, go ahead and submit those now in the chat or the Q&A. I think maybe we have a decimal point wrong, Steve. I don't know.
On which?
Do you see the chat? Is actually
yes, I see the chat. I just don't know which chart. The one we just looked at?
Maybe your spreadsheet. I don't know.
I can take a look.
Yeah. The last one. So let's see what we got here.
Yeah, those are percentages. There should be a percent behind them. So it's, yes, the exact value is 0.00, and then all those.
Yeah. So 88 basis points.
I'm not displaying the percentages. Yeah, those are basis
Thank you,
points.
Brian. Yep, basis points, correct. All right. Yeah, just go ahead and submit any additional questions. Upcoming, again, we've tried to chronicle all of our webinars on our YouTube link. You can see at the bottom. Also in the knowledge base, we're incorporating those. You will, again, as I mentioned at the top, receive a copy of today's slides and a link to the recording in an email that you'll likely receive on Monday. So be on the lookout for that. We'll be back in September for another edition of Coffee Talk. David or Steve, any final words before we let everybody get to their weekend?
No, thank you very much. And again, please reach out if there's any issue that you would see emerging, that we would certainly gladly talk with you about that, because we have the ability to work with financial institutions now in 34 states. And it's, we certainly would love to connect with you and just offer, hopefully you see even these coffee talks as willingness to just share our perspective based on kind of aggregate experience with other clients.
Yeah, thank you, David. Steve, any final words?
No, just as a personal note, my two boys are headed back to school. My older one is starting high school this week, and my younger one is starting middle school. So if I look somewhat frazzled on our next coffee talk, I apologize in advance. I am accepting any advice, any prayers, or anything from the group.
Well, good luck with that. Again, everyone, thanks for joining us and taking time out of your day. We'll get an update from Steve next month on how school started, and we'll look forward to seeing you on the 27th. Have a great weekend.
Thank you
Thanks,
all
everybody.
very much.